At the end of the day, we know you have a lot of options when it comes to deciding where to keep your cash. We believe the Wealthfront Cash Account is an ideal place for your short-term savings, whether you're building an emergency fund, saving for a home down payment, or just want to help your short-term cash grow. We believe this because the Wealthfront Cash Account offers a high APY, so your money reliably earns more for you with no effort, fast and easy access to your cash with unlimited fee-free transfers to external accounts and a network of 19,000 plus free ATMs, and FDIC insurance of up to $2 million. That's right, $2 million through our partner banks. This is 4 times what you get from a traditional bank. And we also offer near instant transfers to Wealthfront's award-winning investment account to invest your money in minutes during market hours. There's absolutely no account fees. So what else do you need? Let's talk about APY. APY, which stands for annual percentage yield, is the real rate of return earned on your cash, taking into account the effect of compounding interest. Unlike simple interest, compounding interest is added to your balance at the end of each month. And with each period going forward, the account balance gets a little bigger, so the interest paid on the balance gets bigger as well. APY calculates the percentage of growth that will be earned in compound interest, assuming that the money is deposited for 1 year. But let's talk about why the Wealthfront Cash Account APY is so high. First, to understand why many banks could pay you more interest, you need to understand how they make money. Consumer-focused banks use your deposits to make loans, meaning that their profits are largely determined by the interest earned on the loans that they offer to consumers. These loans are typically in the form of home equity loans, personal loans, and then standard home loans like mortgages. A bank's profit is the interest it earns on those loans minus the interest it pays on deposit accounts. Profit margins grow when the interest rate charged on loans goes up faster than the interest rate paid on deposits. Now, the federal funds rate is the rate at which banks loan money to one another, and it falls within a target range set by the Federal Reserve's Federal Open Market Committee, FOMC. Now, the FOMC has raised the target range for the federal funds rate quite a few times in 2022, and likely will do so going forward. And when the Fed funds rate goes up, banks earn more when they loan out your deposits. So in theory, they can pass along at least a chunk of that interest to you, right? Well, this makes sense in practice, but many banks don't actually do this. The average savings account APY that banks pay out has barely budged in 2022, even though the target range for the federal funds rate has increased dramatically. Why do banks do this? We know many banks pay you a low rate on your deposits because they've learned that they can generally get away with it. That sucks. Back around the start of the 2008 financial crisis, banks lowered interest rates to nearly zero and learned that they didn't lose depositors. So as a result, even when rates go up, many banks tend not to pass that along to their clients. Okay, so why is our APY so high? Well, we pass along and will continue to pass along a high percentage of each rate increase to you because we believe it's the right thing to do. If we're making money, we think you should be as well. Wealthfront currently has and will continue to have one of the highest APYs on the market. We also have a proven track record of passing along a large portion of every federal funds rate increase since we opened the account in 2019. Now, you might wonder why Wealthfront does not always pass along 100% of every Fed funds rate increase. That answer relates to how we make money on the cash account, which is on the modest spread between what our partner banks, where we deposit your savings, pay us and what we pay you. As you likely know, Wealthfront partners with multiple banks to offer you the cash account, and the cash account APY is highly dependent on the rate that those banks pay us for those deposits. The rate we get from our partner banks varies based on the federal funds rate and how much of a premium that they are willing to pay for additional deposits. Recently, that premium has been decreasing, so we have needed to raise our rates a little more slowly than the Fed funds rate has gone up in order to keep our spread roughly the same. However, we still manage to pass along more than our competitors, and often a lot more. But that's not it. Not only does the Wealthfront Cash Account pay you more interest than most banks, it also offers up to 8 times the protection that they do. Here's how. The FDIC, Federal Deposit Insurance Corporation, was founded in 1933 as an independent agency of the U.S. government. It protects the cash being held in bank accounts up to $250,000 per depositor, per FDIC insured bank, per account category. So if your bank were to suddenly lose all their money, the FDIC would pay you as soon as possible, via either a new account at another insured bank or a check in the amount of your insured balance. Now, if you have accounts at multiple FDIC insured banks, you're covered up to $250,000 at each bank. And the Wealthfront Cash Account offers up to $2 million in FDIC insurance per depositor. which means you're covered up to $4 million for joint accounts. Now, we're able to offer this $2 million of FDIC insurance by sweeping your money into up to 8 banks that are protected by the FDIC. And because we use multiple banks, we can provide more insurance than that $250,000 offered at single banks. It's nice to know that your money is protected while also earning more. And while it's always important to get the most out of your savings, it's especially important to do so when inflation is high and your cash is at a much greater risk of losing buying power. Your cash loses buying power when it has a negative real return. And real return is your nominal return, basically the stated rate on your savings or cash account, minus the rate of inflation. Cash seldom has a positive real return when inflation is low, but the issue becomes much more serious when inflation is at historic levels. Pretty much everyone will find it necessary to hold at least some cash for everyday expenses and an emergency fund, so it's important to have a plan to maximize the value of that cash. An easy way to do this is to make sure it's earning a high APY. And you'll find there's a big range in terms of the APYs that various financial institutions will pay you. Currently, the average savings account only pays 0.21% APY according to the FDIC.gov as of October 17. While your cash is unlikely to earn enough to keep up with the inflation, even with the high rate that we pay at Wealthfront, every little bit helps. It really does. Not only does it matter that you earn more, but if you can also avoid paying any account fees on your cash, your short-term savings will stretch even further. Keep your cash at a financial institution that pays a high APY and charges no fees to maximize your earnings. You should also make sure that your cash is protected by the FDIC insurance to the max. Wealthfront does that. YouTube is a great place to learn all the financial 101 lingo that we never learned in high school and college. I'm here to teach that. Hit subscribe and follow along. Many people feel as if they should hold on to more cash than usual during uncertain economic times. But periods of high inflation are actually some of the worst times to keep a bunch of cash around. We recommend you hold only enough cash to cover the following: cash to cover the current month's expenses like rent, groceries, and other bills; cash that's in an adequate emergency fund, which is usually 3 to 6 months worth of expenses. Where you fall within the 3 to 6 month range will depend on your age, profession, total investable assets, and the likelihood that you'll encounter other financial responsibilities. Like, for example, providing financial support to a family member. And then enough cash to cover whatever you're saving for in those short-term goals. And we define a short-term goal as one occurring within the next 3 to 5 years. You can check out this blog post for more detail on saving for long-term or short-term goals in the link below. So we think you should pick a financial institution that you trust to consistently give you as much interest as it can over time and then stick with them. At Wealthfront, we are committed to passing along as much interest as we possibly can while also giving you the maximum protection through FDIC insurance. We promise to continue to keep doing so, and we also promise to be 100% transparent about why we offer the APY that we do. I think the choice is easy. I'm Tony from Wealthfront. Take care.